In this video, we'll cover 3 hedge fund ETFs. Hedge funds are considered an alternative investment, thus these hedge fund ETFs are classified as alternative ETFs, also colloquially known as liquid alts, due to their greater tradability compared to hedge funds. Methodologies among hedge fund ETFs vary. Some funds seek to track indexes that replicate hedge fund returns, some seek to copy actual holdings that are reported by hedge funds quarterly, and others simply use an overarching hedge fund-like strategy like long short, market neutral, currency carry, merger arbitrage, etc. First is RPAR or RPAR, the RPAR Risk Parity ETF. RPAR from Toroso Investments is far and away the most popular fund of this type with over $1 billion in assets. For all intents and purposes, it is basically the famous all-weather portfolio in a single ETF. For that convenience of being completely hands-off, RPAR commands a fee of 0.50%, not exactly cheap, but certainly much less expensive than an actual hedge fund. The fund has target allocations of 35% tips, 25% global stocks, 25% commodities, and 15% treasury bonds, and rebalances quarterly. The treasuries are leveraged. It's my understanding that the fund has total exposure of 120%. I reviewed the details of this fund in a separate video here. Next is QAI, the IQ Hedge Multi-Strategy Tracker ETF. QAI from New York Life is a fund of funds that covers multiple hedge fund return sub-indexes, thereby attaining exposure to a myriad of hedge fund trading strategies: global macro, long short, fixed income arbitrage, market neutral, event driven, and emerging markets. In doing so, QAI allows investors to avoid having to choose a specific strategy, which is likely the reason why it's one of the most popular liquid alt ETFs out there with over $800 million in assets. The fund has 54 holdings and an expense ratio of 0.78%. Last is MNA, the IQ Merger Arbitrage ETF. MNA is also from New York Life and is only slightly behind QAI in popularity with nearly $700 million in AUM. This fund uses what's called a merger arbitrage strategy, buying companies that have been announced as targets for acquisition or takeover. MNA's long exposure to these takeover targets is offset with short exposure to broad global equities indexes, providing concentration and low correlation to broad equities. The arbitrage opportunity comes in the form of the difference between the current price of the acquired company and the price received from the buyout. Out of these 3 funds, MNA has by far the lowest correlation to the broader stock market at about 0.5. MNA has 34 holdings and an expense ratio of 0.77%. But should you invest like a hedge fund? Probably not. Click here to watch my video where I explain why.